Jordan thought he had everything figured out. He moved his money into a high-yield savings account, paying 4.5%. He had done the research properly. He understood that traditional savings accounts were a bad deal and practically a joke. While most people around him were earning just 0.45%, he was now earning 10 times more. In his mind, he had finally optimized his money. He genuinely believed he had solved the problem. But he hadn't. What Jordan didn't realize was that his bank was still making more money off his deposit than he was earning from it. And even worse, the exact system working behind his account was something he could have accessed himself and kept a larger share of the returns. Now here's where things start to get uncomfortable. Jordan's coworker, Maya, had $20,000 sitting in a traditional savings account. She wasn't doing anything unusual. In fact, she was doing what most people are taught to do: save money, keep it safe, and let it grow slowly over time. At the end of 1 year, her bank paid her just $76 in interest. That was it. A full year of saving for the price of a small dinner. But during that same year, her bank took that exact $20,000 and used it to generate over $1,200 in profit. Maya received $76. The bank kept the rest. And the worst part? She had no idea this was happening. From her perspective, she was being responsible. She was building an emergency fund. She was being careful. Every month, she saw small interest deposits and felt reassured. It felt safe. It felt stable. It felt like the right thing to do. But her savings account was only paying about 0.38% annually. That means on $20,000, she was earning roughly $6 per month. Not even enough to cover basic daily expenses. What Maya didn't realize is this: the moment she deposited her money, the bank immediately put it to work. But not for her. For themselves. This is the core business model of every bank. They take your deposits, pay you a very small return, and then lend that same money out at significantly higher rates. That difference is where they make their profit. It's called the net interest margin. And right now, in the US, that margin is around 3.39% on average, the highest it has been in years. Let's make that real. Maya earned 0.38%. Her bank earned around 3.39% using her money. On $20,000, that difference translates into hundreds of dollars in profit every single year. Maya got $76. The bank got over $600 just from the spread. But that's only the beginning. Because the real profit doesn't come from one source. Banks don't just lend your money once. They multiply it across different financial products. Credit cards are one of the biggest examples. The average credit card interest rate is around 21%. That means banks are taking money funded by deposits like Maya's and lending it at extremely high rates. Auto loans sit around 7.5%. Personal loans around 12%. Mortgages around 6.8%. Every one of these loans is partially funded by deposits like hers. And every single one creates a massive gap between what the bank earns and what the depositor receives. Then there's another layer, something even simpler. Banks also take a portion of deposits and invest in U.S. Treasury bills. Right now, short-term Treasury bills are yielding around 3.6%. So the bank can take Maya's money, earn 3.6%, and pay her just 0.38%. That's a 3% difference on something she could have accessed herself directly. In other words, the bank is acting as a middleman between Maya and the U.S. government and charging her for it. And the system doesn't stop there. Banks also generate billions from fees every year: overdraft fees, ATM charges, maintenance fees, and transaction penalties that in a single year, U.S. banks collect over $12 billion in these fees alone. Major banks like J.P. Morgan Chase and Wells Fargo make billions from customers who are often the same people whose deposits are funding the entire system. On top of that, there's interchange revenue every time you swipe a card. There's float income when banks hold your money for even a short delay. There's even value extracted from customer spending data. Every angle becomes another stream of profit. So when you combine it all, the picture becomes very clear. Maya's money wasn't sitting safely in a vault. It was actively being used, multiplied, and monetized. She wasn't just a customer. She was the product being rented out. Now let's go back to Jordan. Jordan is smarter than Maya, at least financially aware. He moved his money into a high-yield savings account, paying 4.5%. So instead of $76, he now earns about $900 a year on $20,000. That's a massive improvement. No doubt about it. He is earning nearly 10 times more than the average saver. But even Jordan hasn't reached the end of the story, because there are still hidden problems. First, that 4.5% rate is not always guaranteed. Many high-yield savings accounts advertise up to rates. That up to is very important. Sometimes only a small portion of the balance earns the top rate. Sometimes it is promotional for a limited time. And sometimes the rate quietly drops without much notice. So Jordan's real effective return may not be as stable as he thinks. Second, taxes. Interest from savings accounts is taxed as ordinary income. That means federal taxes plus state taxes. If Jordan is in a 22% federal bracket and a 5% state bracket, he loses around 27% of his earnings. So his $900 becomes roughly $650 after tax. Still better than Maya, but significantly reduced. Third, and most important, the structure hasn't changed. Jordan is still inside the same system. His bank is still taking his money and doing the exact same things, lending it out, investing it, and profiting from it. The only difference is Jordan is getting a slightly larger share of the return, but it is still just a share. The bank is still the middleman, and the middleman is still taking a cut. So the real question becomes, if the bank is using my money to buy safe assets like treasury bills, why don't I do that myself? Let's compare all three scenarios. Maya earns $76 a year, about $55 after tax. Jordan earns about $900, roughly $650 after tax. But a third option exists. If you directly invest in short-term treasury bills or treasury ETFs like SGOV, you earn around 3.5% to 3.95%. On $20,000, that's roughly $700 to $790 per year. And here's the key advantage. That income is exempt from state and local taxes. So after taxes, the final amount can be closer to Jordan's, sometimes even better depending on where you live. More importantly, there is no bank deciding your rate. No hidden up to structure. No sudden changes. You are directly tied to government-backed securities. No middleman taking a cut of your yield. Now, of course, banks still have advantages like instant liquidity and FDIC insurance up to $250,000. But treasury bills are also backed by the U.S. government, the same entity behind FDIC protection. So the safety argument is not as different as most people assume. The real difference is control and efficiency. So what does this all mean? Maya followed the system exactly and got almost nothing. Jordan improved his position significantly, but still stayed inside the system. Neither of them asked the most important question, what is my bank actually doing with my money? And more importantly, can I do it myself instead? Because the answer is yes. Your bank takes your money, invests it, and keeps a large portion of the returns. But with a little awareness, you can step outside that structure and capture more of the value yourself. The smartest financial move is not just finding a better savings account. If you found this helpful, subscribe, like, and share for more content like this. It helps us grow and bring more insights. Comment your thoughts below and let us know what you think about banking system and hidden profits. Stay tuned for more financial breakdowns. Thanks for watching, always learning.